Well, good afternoon. Thank you very much again back at the Wehrly group. Thank you for being on our channel today and subscribing to the channel if you find this information interesting. Again, please know that we don't just decide on what we're going to do. We make a video, we make a program to answer questions that we get a lot of. One of the things we found out years ago is it's easier to give one basic set of information to 35 people one time than to explain it 35 different times to 35 different people. So we've been doing this for a long time. It's very effective for us. But again, thank you for joining us. When we ask people, why did you choose us? There's lots of planning groups and lots of people you could have worked with. What's the number one reason? Why did you choose us aside from our good looks? What's the other reason? And people always say the same thing. Love working with tax experts. As you know, Daniel is a certified tax preparer, president of our tax department. I'm an enrolled agent with the United States Treasury Department, basically admitted to practice in all 50 states, which that was a hard test to pass. But again, a lot of our business is not only tax design and tax advice, but also income tax preparation. A lot of people feel comfortable that we can create a Roth strategy or create some other strategy that's going to reduce or eliminate their income taxes in retirement. And we can do that so effectively by actually completing and filing the income tax return for them at the end of the year. So again, if that's something that's of interest to you, please contact us and we could discuss that. Now, what I want to talk about today is when people say the word taxes, there's hundreds of different taxes. And sometimes when they're asking a question about an inheritance tax, that's kind of on a lot of people's minds right now because of a change of administration in Washington, D.C. What they're really asking about is a federal estate tax. And otherwise there are state tax that starts with an S, federal estate, E-S, taxes. There's a lot of issues there. So I've been getting a lot of questions lately, again, because of this new administration, and I wanted to cover very briefly some of the basics that'll help you kind of deal with this. Once again, of course, income taxes. If you'd like your income tax bill to go down, we can generally help you with that. If you'd like it to go down dramatically in your retirement age, or maybe you're already retired, we can help you with that as well. So a couple things from 30,000 feet. Probably the issue we get the most questions on. I had two clients already in my office today. Another gentleman will be in this afternoon. All three of them are trying to figure out RMDs, required minimum distributions. I won't waste your time, but I've heard everything you could imaginable about what an RMD is and what it stands for and how much money you have to take out of your IRA and all those kinds of things. I must say, I'll never forget, I was teaching a class years ago, and a very nice lady was in the class, and I asked everybody, can anybody tell me what happens at 59 and a half? If you have an IRA, if you have a qualified account, if you have an account that you haven't paid taxes on yet, at 59 and a half, what happens? And she raised her hand, and she got up, and she said, at 59 and a half, you don't have to pay income taxes anymore on your IRA. Which, by the way, is the wrong answer. So, much to my amazement, I said, does anybody else think the way that this young lady thinks? Is that your opinion? And 5 or 6 other people thought that at age 59 and a half, they didn't have to pay taxes anymore on their IRAs, and of course, nothing could be further from the truth. By the way, if you're not familiar with the pre-59 and a half, 10% penalty, all that happens at 59 and a half is you no longer have to pay a 10% penalty on top of your federal income taxes. So, but anyway, I just wanted to give you an example of kind of how that works a little bit. So, at age 72, used to be age 70 and a half. Don't know why it was 70 and a half. Don't know why it wasn't 70 or 71. But for many, many years, at 70 and a half, when you turned 70 and a half, you had to begin withdrawing some money from your IRA, your 401k, your HR10, your KEO, whatever the account is. And the reason why is the IRS has been waiting, and they've been waiting and waiting since you first started contributing money, probably to a company-sponsored plan, and now they'd like to get some money. They'd like to get some taxes. So you have to take out about 4%, round figures, out of your account. You don't have to spend it. You have to take it out, pay taxes on it, and maybe set it up at even a duplicate account if you'd like. But you do have to start paying taxes. And of course, as you get older, that percentage, of course, gets a little higher. Instead of 4%, it's 5%, 6%, and 7%. Well, here's the problem. Generally speaking, the balance, the amount of money in your IRA is likely going down. So it's going down a little. That's one dynamic, maybe. Depends on your investment results. But the amount of money that you have to take out, that you are required to take out, think of it as you're forced to take it out. Maybe we should call them forced mandatory distributions instead of required minimum distributions, but it's the same concept. So again, I've heard stories from people saying you have to take all the money out when you turn age 72. That's not true. Other people say you don't have to take any money out if you're still working, which may be true. I mean, there's just a lot of things happening there. So again, if you have a question specific to your situation, get in touch with us. We'd be happy to give you the information that you need so you don't have an RMD sword hanging over your head, not really knowing what's about to happen to you. By the way, a number of people that we meet will tell us when we're discussing maybe taking some money out of their IRA, paying the taxes on it now, and putting it into a Roth IRA. Many people will say, well, I'm not going to do that now. I'm going to wait until I retire, because when I retire, my income tax bracket is going to automatically go down. Well, please know that the tax law doesn't work that way. There's nothing automatic about anything. We have people, by the way, that are making about the same amount of money or more in retirement than they were when they were working. Well, so your tax bracket's not going to go down. By the way, I had a gentleman that called the other day, had a very large IRA, and his RMD, which was going to start the following year, next year, the year after we were speaking, his required minimum distribution, the amount of money that he had to take out, was about $120,000. No kidding. In other words, he finally quits his job, gets into retirement, and has to start taking $10,000 a month, $120,000 divided by 12, out of his account. His income was actually going to go up. In other words, his tax bracket was actually going to be higher in retirement than before. So again, not an often understood subject, RMDs, those kinds of things. Another thing that we really are starting to get a lot more questions on is the federal estate, E-S-T, federal estate tax, sometimes called a death tax. Notice it's federal. So let's talk first of all about state taxes. If you pass away in certain states, usually in the Northeast, Connecticut, New Jersey, Vermont, things like that. In some cases, you may have to pay a tax to the state that you live in. So let's talk a little bit about that. My screen has changed here, but some states have what's called an inheritance tax. And that tax is not a matter of the federal government. It's because you live in Illinois and you died in Illinois, or your parents did, or other things. So that's a state inheritance tax. Now, Texas, state we live in here, and we have locations in other states as well, we don't have a state inheritance tax. If you pass away, your mom or dad die, then the money, of course, goes to your beneficiaries. That being the case, all the states have a federal estate tax, and that's kind of where the problem can get started. Many years ago, it was quite low. A lot of people with a moderate-sized estate would pass away. We're doing their income tax returns, and we would have to call the children, the beneficiaries, and say, hey, bad news. Mom and dad had a pretty good-sized estate, and we're going to have to compute and pay within 9 months a pretty substantial federal estate tax. By the way, a real quick little kind of thought about that is IRAs, remember, if you have a $100,000 IRA, then again, that's a pretty good size asset. But by the time that you withdraw that money, or you inherit that from your dad, and you pay the taxes on it, depending on how much money you make every year, your AGI, your adjusted gross income, you may only get 65 or 70% of that. The rest of it's going to have to go out for taxes. Well, in the federal estate tax world, if you inherit a $100,000 IRA, even though you're only going to get $65,000 of that money by the time you pay taxes on it, the way the tax code works is the tax code counts that $100,000 IRA that you inherited from your mom and dad at $100,000. So it's probably not the best way to do it, but that's the way the tax code works, and that's how we have to compute the tax. Anyways, back to the subject. So that being the case, right now, you have about a here in 2022, you have about a $12 million exemption. In other words, you owe the taxes, you owe federal estate taxes, but you have an exemption. You're able to inherit about $12 million these days, and that figure may go up or down a little depending upon what Washington decides to do. And remember, presently we're operating under what's called the Tax Cuts and Jobs Act. Tax Cuts, Jobs Act. Of course, that was passed in December of 2017. A lot of people attribute that to Donald Trump. Of course, Donald Trump can't pass tax law. It's not how it works in the United States of America. Congress had to do that, maybe with some pressure from certain political parties, but it was not Donald Trump's law, Tax Cuts and Jobs Act. By the way, notice that the Tax Cuts and Jobs Act kind of gives us a clue what we're dealing with, what some of the legislation was. So let me give you a quick bit of homework here. Many years before that, many years before Tax Cuts and Jobs Act passed, we had another legislation, very landmark legislation that passed, tax law, called the Taxpayer Relief Act. Well, again, based on the name, judging from the name, you can get a pretty good idea that there was some relief going on for taxpayers, you and I, in that act. My question is, and very, very few people are able to answer that question, is what form of relief was available in the Taxpayer Relief Act? Because we don't get a lot of relief from taxes. IRS, the tax law is not set up that way. So again, you might want to find out more information about that. Perhaps Google that. Or here's an idea. You could call us. Say, hey, Mr. Wehrly, Mr. Martin, I kind of want to make sure that I get whatever form of relief I'm entitled to as a tax-paying American citizen. Again, landmark legislation, a lot of lives have changed. Our whole firm is built around building and working with making sure that people get relief legally and ethically that they're entitled to as American citizens. So again, we've talked a little bit about the RMD, the required minimum distribution. Again, about a little over 3.5–4% of the money you have to take out starting at age 72. Again, we can talk a little bit more about that. We've talked a little bit about state inheritance taxes, and we have a lot of clients that live in those states, and so that's something we may want to talk about. We've talked a little bit about federal estate taxes. Not too much of a problem right now, but again, as the Tax Cuts and Jobs Act dramatically increased the amount of money that you can inherit and not have to pay federal estate taxes on, the next president may come along and he may change the changes to the changes that the other president changed. Happens all the time. So you have to be careful. And again, there are planning options available to you legally and ethically in the tax code to prevent some of that. Next little issue that we've heard a lot of is long-term capital gains treatment. So I'm sorry that's kind of a long concept there, but what we're talking about is if you buy a share of AT&T stock and you own it for a year and a day, because the tax law says that you have to own it for more than 1 year, a year and a day, a year and 2 days, a year and 5 days. So as long as you've owned it for a year and a day, then your tax, the amount of tax that you have to pay on the profit that you might make from your 1 share of AT&T stock, that tax is handled differently. It's a different tax, often a smaller tax than your regular income tax would be, what we call an ordinary tax rate. So Mr. Biden and some of the new people here, the new administration, not being political, but there are people that would like to remove that long-term, more than 1 year, that long-term capital gains treatment. We can't comment on what may or may not happen in the future, but again, presently, here in early 2022, it's still the law, and there's a lot of people that have considered selling buildings that have gone up in value, or maybe homes, rental properties that have gone up in value, stocks that have gone up in value, and wanting to make sure that they sell them at a time where they pay this lower, smaller tax because of the long-term capital gains treatment. So again, hard to say what that looks like. If you have questions about that, if you have highly appreciated stock, maybe you bought a bunch of Apple stock years and years ago. I have a client, very fine man, probably watching this particular channel, and he bought a whole bunch of Amazon years and years and years ago. And brother, it's gone up and up and up and up, and he's certainly glad, I'm sure, he made that decision, but now he's got a tax problem. So again, it's a good problem to have. So again, if you have highly appreciated assets and you want to talk to us, consult with us about maybe making a charitable gift. Oh, wait a minute, that's a great idea. You can give certain assets under certain circumstances to your church. You can support your church and your doctrines and your community, and they don't have to pay any taxes on any of that. So in other words, all the money goes to them. So that, if that's of interest to you, you might want to give us a call. Again, if you want to have that long-term capital gains treatment conversation with us, where maybe you want to sell a few of these shares because they've gone up in value, and maybe sell a few of these because they've gone down in value, kind of look at what that looks like. Again, that's a tax conversation. Please know that. A lot of times we'll be visiting with somebody and they'll make a pretty serious mistake. And we'll ask them, how did you make this mistake? What were you thinking when you did this? And they'll say, oh, well, my stockbroker or my financial advisor suggested that. I said, oh, is he or she a CPA? Well, no. Is he or she an enrolled agent, a certified tax preparer? No. Well, that might have been how you got into trouble. So again, if you have a problem with your foot, go to a podiatrist. If you have a problem with your heart, you might want to see a cardiologist. Don't get those two doctors confused, and don't get tax experts and their advice that they're able to give. Don't get that mixed up with other people that sometimes don't have that level of information or advice. You don't want to make a problem with the IRS. The IRS is many things, but they don't suffer tomfoolery. So again, make sure that you know what you're doing, why you're doing it, acting in your best interest, and you can get that from friendly, experienced, and personal advice. Again, we like to believe that we're leaders in this industry because we listen. We listen to what your problem, your situation, your inheritance, your family, what all that looks like, to make sure that we have all the T's crossed and all the I's dotted before we proceed. So thank you again for watching. We appreciate your time and your interest. Give us a call if you have any additional questions on your particular situation, and we'll look forward to seeing you in our office one day very soon. Thank you very much.